Hi, welcome to Retiring Well. Folks, we got a great show for you today. We're going to be talking about safe withdrawal rates, what that is, what's the concept, fees and commission, why it's important to know what they are. How about rental income? Get this asked a lot. Should I get involved in that? What are needs when it comes to life insurance, right? And what are ABLE accounts? Okay, this is for disabled kids, so it's a good way for you to save. So folks, talking about a lot today, stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
I want to talk in this segment about what we call the safe withdrawal rate, okay? Now, what this is the concept is simply this. It's an amount or percentage of a portfolio that you can take from that is considered safe in the sense that you're not going to run out of money. You might even grow your principal a little bit over time. Okay, so it's not brain surgery, all right? If I got a portfolio that's making 5, 6, 7% on average, and I'm pulling 4, 5% out, maybe that's what I've deemed a safe withdrawal rate, then that works all day long, right? Because I got 5, 6, 7% pulling 4 or 5% out. That plan's going to work forever, right? Now, that's the concept, but you have to understand, you're going to want to make sure that you don't have any big losses in that picture. Remember, that concept only works if you're averaging that as a rate of return with no hiccups. Now, let me give you a case where this can be bad. Let's say I got a portfolio that's maybe, let's say just $500,000, just so we use a round number, and I'm pulling 5% off. So now I'm taking $25,000 a year for income, okay? As long as that portfolio continues to make 5% or more, I'm good, right? But what if we have like a 2008 and that portfolio drops to half its value? If I needed that $25,000 for income and now my account's only worth $250,000 and I'm pulling out $25,000, folks, you're now pulling out 10%. Now, how do I grow it back? I've got to get a better than 10% rate of return from here on out just to even start building that portfolio back up. So you want to understand that that concept works, but you're not going to have any big losses. It used to be that when you got close to retirement or in retirement, you were in what you call the preservation of wealth and income phase of your life. Most would just move from equities into fixed income accounts like bonds when they were paying, let's say, 5, 6, 7% or more. Today, the yield on bonds is so low, it's hard to make that move without having a mix of stocks in there. And of course, with stocks or equities, there's risk. So you want to be well diversified, you want to be positioned accordingly. Be careful of those income plans out there. There's a lot of income plans. All advisors have the tools. They'll tell you that you're never going to run out, but remember that one assumption is that rate of return they put in there, that growth rate is going to be consistent, and sometimes that doesn't happen. All right, remember in retirement, your number one enemy is going to be volatility, as I explained earlier, so be careful.
NMC Extended Education is introducing an educational class titled Retirement Secrets, Your Best Is Yet to Come. Our very own Larry Flynn will be the presenter. If you are nearing retirement or already retired, then this class is for you. Many things can threaten your ability to outlive your assets and retire well. The three big things being healthcare, inflation, and taxes. Learn to navigate the critical issues that a retiree must deal with. You'll learn how to plan for a predictable and sustainable income, minimize taxes on your IRAs, maximize your Social Security benefits, and avoid estate planning mistakes. We'll also discuss long-term care concerns and what investments are appropriate in different situations. The cost is only $69. Materials will be provided, and a spouse or guest may attend for free. The class will be held on 2 Wednesday evenings at 6 p.m. for 3 hours, April 1st and 8th at the NMC Great Lakes campus. Reserve your seats today by calling NMC at 231-995-1700. The class is called Retirement Secrets. Again, that number is 231-995-1700. Hi,
in this segment, I want to talk about fees. Listen, understanding how your advisor is getting paid is very, very important. Now, we actually have the tools to take any portfolio, get behind it, and show you exactly what you're paying in fees. But I just want to speak to it because those fees can take different shapes and forms. So for the most part, if you're dealing with an insurance product, whether that be an annuity or be life insurance and the like, most insurance companies pay the advisor a commission. Okay, and they usually get a bigger commission if that annuity is of a longer period of time. Okay, in life insurance, it's usually a percentage of the first year premium. But typically, when you're dealing with an annuity or life insurance or an insurance product, the advisor is getting a commission. There's usually no charge to the client in that environment, no fee to the client. So that can be a good thing. Another way insurance companies can charge is when they have these annuity products. Sometimes they'll come with these riders, whether it be a guaranteed death benefit that's going to be there in case something happens, or a guaranteed income stream that's going to be there. And usually they call these riders because there's additional benefits associated with a contract. And there's typically a rider fee that the insurance company charges. Now, in this particular case, unlike the commissions, that fee is getting charged to you because if there's an investment side to that thing, there's usually that fee is coming off that investment side. So knowing if there's any of those kind of rider fees is going to be important to know. Mutual funds have fees. They have what they call expense ratios. That's the general administrative and research costs that they're having to pay to run that mutual fund, and they pass those costs on to you, and basically it just comes out of the performance. Now that expense ratio, what they're charging you, has to be disclosed in the prospectus. So if you get that annual prospectus from that mutual fund, you can go in there and find out exactly how much you're paying in that fees that's just coming out of your performance. Now, if you have assets under management, this is where a portfolio is actually being managed by an investment company advisor. Typically, how you get charged in that kind of environment is there's a percentage that they charge you on the balance of what's in those accounts. They call it assets under management. Typically, you'll see anywhere from 1%, sometimes up 1.5%. Now, where your funds are held, that's typically with a custodian. You want a custodial relationship because you want that custodian reporting to you everything going on in the account. Okay? In the past, we saw a lot more custodians charging a fee for the trades that were under those accounts. Today, because of competition, a lot of these custodians are now not charging any trading fees. Now, they'll charge you a fee when you exit maybe a qualified account because they have to do a 1099 at the end of the year, but for the most part, no fee. So hopefully you found that valuable. But again, understanding how you're getting charged and what you're paying, very, very important.
Well, that was really good information, Larry, but above and beyond that is you're looking pretty good. You got a nice tan going and everything, so you must be feeling good too.
Well, it helps when you've been in Florida for a little bit. So
that definitely helps. But we're going to be talking a little bit more about that safe withdrawal rate, because when Larry was talking through that, one of the things that popped in my head is when people are sitting down with us for that first time, we're talking about ultimately how much do you need to retire? And everybody has these figures in their mind of, oh, I've got to have $1 million saved or whatever that might be. But it's so interesting when we run the numbers, it's backing into it to see, well, what are your expenses and what are those known fixed income streams that you might have? So, Social Security, if you have pension, okay, well, what amount does that make up? And then ultimately, what's that gap that's left between what your expenses are and what your fixed income needs are? And then it's back engineering ultimately to say, oh, well, I've got X amount saved. If I withdrew 4%, 5%, whatever it might be, oh, that bridges that gap. And so I think so often, Larry, people get so set on a certain dollar amount, but really it comes back to what that income stream is that they need.
Right, what kind of income do they want? And everybody's different, right? How much income they want, what do they have in savings? I just thought the probably the most important thing I tried to draw their attention to is once you develop that plan and that's what you're going to take out, boy, you better be sure to continue to get that as an average rate of return because you can't have any volatility when it comes to that. So, and as far as the fees, I just wanted, I think people want to know. I've never met anybody yet that said, nope, I don't care about what the fees are, right?
Right.
But when you tell them and you're transparent about it, they don't mind you getting paid. They just like to know how you get paid. Sure. So anyway, stay tuned because I got more for you.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
In this segment, I want to talk to you about rental income. Okay, very, very important. It can be a valuable part of a retirement plan too, as I'll explain. First of all, when you're looking at rental property and you want to know if it'll be good rental income, you're going to have to know some numbers. First of all, you're going to have to calculate what you think is going to be the rent you're going to receive. Okay, so you get a good idea how much rent you can charge, and then you want to get an idea what costs are you going to have to incur: taxes, insurance, whether you pass the utilities on or not. What are those costs going to be? Because what you want to get to is what's called the net benefit. That'd be your gross rental income after all your expenses, and what am I going to get as a net benefit in rent? Okay. The next thing you want to do is what's the amount you're going to be paying for this property, or what if you already own it, what is the fair market value of that property? Okay, so if I get that net rent benefit and make that a yearly number, and then I divide that by the fair market value or purchase price of the rental property I'm trying to purchase, now what you're going to get is a rate of return. Okay, so let's say you get a rate of return of, let's say it ends up being 7-8%. Well, you're going to look at that's going to be very, very good rate of return, right? How much risk do I got to take in the market just to get maybe that same number? So that's going to be valuable to know. So when you're looking at rental property, please look at it first that way. The other thing you get with rental property is if it gives you a good rate of return, we're not even factoring in appreciation. If that property goes up in value, you can add that to your rate of return. So let's just assume you say 1%, 2%, appreciation. Now that 7% is 8-9%. So that's a good number to know. The other nice thing about rentals is you get to depreciate them, over a number of years. Typically, I'll find with rental property that depreciation is enough to offset the net rent. So in a lot of cases, you're paying very little or no taxes on that income as you own it. Now, the bad thing about depreciation is when you depreciate it from a tax standpoint, now your basis is lower, and later on when you sell it, you've got this huge capital gain because now all that depreciation has to be recaptured as basically income. But if you have that rental property and you pass it on as an inheritance, guess what? They get stepped up basis on it, and then no tax ever had to be paid on it. The other nice thing about rental income is it's inflationary. You get to raise rent, so as costs go up, you get to raise the rent. So if you've got it as a retirement instrument, it's going to be a good income source for a long, long time. Now, rentals can be a headache. You can pass that headache on to a manager too. Typically, they'll take anywhere from 15-20%, but if you don't want that headache, could be valuable. Hopefully, you found this segment valuable. If you have any questions about this, give me a call.
If you're retired or soon to be retired, let us help you plan to retire well. Centennial Wealth Advisory specializes in retirement planning and has offices in Traverse City, Cadillac, Petoskey, and Gaylord. We'll never pressure anyone to become a client. Our goal is to inform and educate. Simply attend one of our live events or schedule a meeting at one of our Northern Michigan office locations for a free, no obligation retirement review.
We look forward to helping you plan to retire well.
In this segment, I want to talk about life insurance. Now, when I was a young man, had not accumulated a lot of assets, I had 3 kids at home, and I was the sole breadwinner, I found having life insurance very, very important. But you know, as I got older, as I acquired some assets, my kids are now grown up, they're having their own kids now. Did I find that life insurance was as valuable as it was when I was younger? Maybe not. But I want to give you some ideas where life insurance can be valuable in retirement planning, especially in the latter years. First of all, when it comes to life insurance, a lot of people will be paying this premium, and they'll coming in and they're saying, Larry, I'm not seeing much value in maybe having this. I'm paying this premium. Maybe we could have that being going to something different, And what I'll ask them is simply this, what do you need that life insurance for? Is there any need for it at all? Because when you're looking at life insurance, you have to look at it like any other kind of insurance. I have house insurance in case my house goes on fire and I lose it, right? I'm going to want that contingency taken care of. I get long-term care insurance because if I fear I might go into a nursing home, I want to make sure I have the insurance for that. I have car insurance in case I have an accident. I have life insurance in case something happened to me. Does my family need any lump sum of money in any way? I want to assess it simply that way. If I have sufficient assets and I don't really need that anymore, then I would dare say we probably don't need to pay the premiums on it. There's some areas where you might need it. If maybe one of the spouses has a pension and is going to lose some of that pension amount, all or some, if something happened to that spouse, then, or maybe with Social Security you're going to lose the lesser of the two, having a lump sum to replace that income could be important in those latter years if we thought that could happen. We can use life insurance in an IRA exit strategy. Let's say I've got a big lump sum of IRA money, and I'm in such a tax bracket that I can't buy out Uncle Sam while we're both living. But what if that first spouse dies and the second spouse, the surviving spouse, has this lump sum money from life insurance that they can use to buy out Uncle Sam out of the IRA and then forever have tax-free income from then on? That could potentially be valuable. Again, any time I could see where I might need a lump sum of cash for any reason upon my death, then I'm going to want that life insurance. Now, you may not know this, but a lot of life insurance today, the death benefit can now be used for long-term care. So sometimes if you still find life insurance valuable and you want it, you might be apt to maybe want to get some recent quotes because that death benefit can be used for that long-term care. Could be valuable. So hopefully this gives you some ideas where life insurance can be used in your retirement planning. Hopefully you found it valuable.
Well, Larry, I appreciate you bringing up rentals. Obviously, that's something that's close, near and dear to our hearts. That's one where actually my parents, downtown Traverse City, have owned an apartment building since the 70s. And so I grew up sort of around apartment buildings and understanding rentals. And so my wife and I now own rental properties. And I think it's so important, like Larry was talking about, of there's an equation that's involved here. And you got to be paying close attention to not just looking at that revenue, but understanding what are all those expenses, and then along with that, okay, what sort of time are you going to need to be involved, and do you have the time, do you have the know-how or the desire for some of those headaches that come up as you can imagine within those rentals. So it's definitely important when you're looking at that as a long-term investment. I definitely don't view them as a short-term thing, but it's one where, you know, here I am in my mid-30s planning on that as a long-term strategy.
Yeah, and the best kind of rental property to own is rental property that's paid for.
Sure. Oh yeah.
All right, because now 100% of the rent, other than the expenses, are coming back to you. If they're too leveraged, you're taking your profits and you're having to put them on a loan, which if you have time could be good, but if you're getting near retirement, that's not the kind of investing you want to do.
Yeah, and it can be a nice steady income stream and everything that you would have during retirement. And I know the other area you got into was life insurance. Yes. And I've been seeing a lot more people that are looking at this as they get into retirement, and they're sort of trying to get an idea of, okay, am I going to spend through all of my assets through my retirement? And life insurance may be a tool that could be used to help with preparing for that, and also with some of those accelerated death benefit riders that are added today that allow you, in the case of like a long-term care type of situation, that might allow you to draw some money off of that to help pay for long-term care. So I think that's a valuable piece to consider.
Yeah, I was trying to share with our folks that anytime you can see where a lump sum of cash might be needed in an estate, or when somebody passes away, is a good time for it. I think of cottages. Yeah. These people have this cottage on the lake. They want to leave it to the kids, but there's no liquidity. There's no money there to pay for the cost to keep that cottage. Well, life insurance is appropriate in that case, because they have a lump sum there that they can put in an account that can be used solely to pay the cost for that cottage, so the family can continue to enjoy it for quite some time. So anyway, hopefully you're finding this valuable. Stay tuned. We've got one more segment to go.
NMC Extended Education is introducing an educational class titled Retirement Secrets, Your Best is Yet to Come. Our very own Larry Flynn will be the presenter. If you are nearing retirement or already retired, then this class is for you. Many things can threaten your ability to outlive your assets and retire well. The three big things being healthcare, inflation, and taxes. Learn to navigate the critical issues that a retiree must deal with. You'll learn how to plan for a predictable and sustainable income, minimize taxes on your IRAs, maximize your Social Security benefits, and avoid estate planning mistakes. We'll also discuss long-term care concerns and what investments are appropriate in different situations. The cost is only $69. Materials will be provided, and a spouse or guest may attend for free. The class will be held on 2 Wednesday evenings at 6 p.m. for 3 hours, April 1st and 8th at the NMC Great Lakes campus. Reserve your seats today by calling NMC at 231-995-1700. The class is called Retirement Secrets. Again, that number is 231-995-1700.
Okay, in this segment, I want to talk about what's called ABLE accounts, A-B-L-E accounts. Okay, now these are 529 counts. Now 529 is just the IRS tax code number for when this account got created. But it stands for Achieving a Better Life Experience Act. Okay, now this is for disabled kids or people that you want to, that can have savings. And let me just explain some of the details. First of all, anybody can save for a disabled person. It could be a grandparent person or unrelated person. So anybody can save for this disabled person. Now, the disabled person has to have been diagnosed with this disability before the age of 26. Okay, so it's not for somebody that got disabled after that age. They had to have been diagnosed before the age of 26. Now, that person that's disabled can still be receiving SSI, Social Security, and Social Security disability. Okay, and they can still have this savings, and this savings does not count against that income. Okay, if you have a disabled child or know somebody that's disabled, you know that they can only have so much in their account and before it starts to affect, their Social Security disability. With these ABLE accounts, they're able to save up to $100,000. Okay, and that $100,000 can be used for anything from medical to education to tutoring and all kinds of things. So this is a great way for somebody to save, have a lot in savings and have it be there for them somewhere down the line and not affect their disability. Now, when you put money into these accounts, there's no tax deduction for doing so. You're limited to the annual gift exclusion every year. Right now, as of this airing, it's $15,000 that you can gift somebody without having to file a gift tax return. So you can give up to $15,000 per year and save up to $100,000 in these accounts for that disabled person. Now, it used to be to have an account like this, so you had set aside for that disabled person. We had to use what was called a special needs trust. And basically how those work, and matter of fact, you can still use a special needs trust if you find it appropriate. But what they do in these trusts is it's an amount that you can have there for the disabled person, but it's not, they don't own the assets in it. So the money can be used for their benefit, but it's not in their name, so it can't count against them for SSI or disability. So in some cases, these ABLE accounts might be useful. If it's going to be less than $100,000, that'd probably be the simpler way to do it. But if obviously you wanted to save a lot more for this disabled person, let's say it's an inheritance or something, you're probably going to want to use a special needs trust, which means you're going to be talking to an attorney to set it up. So hopefully you found this valuable. It's a lot of people out there don't even know these accounts exist. So if you do have a disabled child or know somebody that you want to put some aside for, then obviously this is something you might want to do. If it's an account you want to set up, give us a call. We'd be glad to help you with it.
Larry, I appreciate you sharing about these ABLE accounts, because quite honestly, it was something that I haven't really come across too often. And so more so, I've had the experience of like the special needs trust, where you get an estate planning attorney involved, and they, someone might have a child that may need some additional help. And so utilizing a special needs trust is another way that assets can be sort of protected from some of these things that you were pointing out. So.
Yeah, John, a lot of people aren't aware of them. They just came out about 5-6 years ago, and there really hasn't been a whole lot of advertisement about it. So I'll talk to people, I'll find out they have, a disabled child or know somebody that's disabled, and I'll mention these kind of accounts to them, and everybody's surprised. They were not aware. I actually have a half-brother that's autistic, and this has been a great financial instrument for which we can save for him. I'm his custodian. He gets SSI, he gets SDI, but he can only have like so much in his account every single month. Okay. I think if I remember, it's like $2,000 is the most he can have. If he has anything more than that, it affects his benefits. So having these kind of accounts that you can save in, so it doesn't affect their SSI is really, really key. Folks, if you have somebody like that that you know of, that you maybe want to set some money aside for, want to save for, then these ABLE accounts are out there. They're IRS regulated. They're basically 529 plans. But if it's valuable, we can help you maybe set one up and help you start to save. As always, we'd love to have you come in and visit us. It's a no obligation, free visit. We're glad to give you a second opinion, see if your retirement plan is well in place so you can plan to retire well. So thank you for joining us today.